Hey folks, welcome to Quantsapp and welcome back to yet another video. In this video, we will learn 10 important option trading strategies which you know if you want to trade options efficiently in all the market conditions. So do watch the video till the very end. So let's start this video by understanding one of the most simplest strategies first, and then we will keep the complex ones towards the end. So let's start this video by understanding few bullish strategies. Okay, few bullish option strategies. So when we talk about bullish option strategies, the first strategy that will come to your mind is a simple long call. You just go ahead and buy a call option. So there is nothing wrong with this strategy. So let's say I am bullish on Nifty. Okay, for an instance, I am bullish on Nifty. 18,600 strike price. The at the money call option is something I am going ahead and buying. So now this will show us the payoff. Architect tool will show us the payoff on what various levels of Nifty, how much profit or loss I am making. If you click on Greeks, that is where the problem in this strategy is. So now see, this is a theta negative strategy, meaning that this strategy, if you are entering this strategy, you will have to pay market the money of time. Okay, so doesn't matter what happens in the market, or even if market does not move at all, you are going to pay 900 rupees as the position theta. Okay, so this is the positional Greeks what we are seeing, but you will pay roughly around 900 rupees to hold this strategy for one more day. So typically when you are trading in weekly options, the theta decays at a faster pace. Okay, and let's say now your forecast, if it takes time, what you will do, you can't hold this strategy for a lot of time, right? Because the theta will keep on decaying the premium, and at the end the strategy will become worthless. So what you can do is a simple addition to this strategy, which is just sell a out of the money call option, so that your bullish view still will be intact. You will be paying, you will still pay a premium. This will still be a debit strategy. It is called as a bull call spread. Okay. So the first benefit of doing this type of strategy is, just look at this. From 900, you cut down to theta what? 400. That is, almost you made it half or even more than half. Now, coming to the other aspect of this strategy, this is a defined loss strategy. You will nowhere face a undefined loss in this strategy. So market going anywhere, maximum loss is 3,060. Profit, just check this out, it is 6,940. So, reward to risk of more than 1:2:1 is what you are achieving in this strategy, which, makes sense mathematically as well. So this is called as bull call spread, a two-leg simple bullish strategy. So in this strategy, this is a bull call spread. It is a net debit strategy. That means the money is getting outflowed from you. Okay. And still this strategy is a theta negative strategy. Okay. It isn't a theta positive strategy. So for this, what we can do is we can try another strategy out, which is a bull put spread. Okay. So we will deploy a bullish strategy, but using put option. So how we will do it is, so let's say put option. So what I'm doing is I am selling an in the money put option, which gives me kind of a bullish payoff. Okay. A short put is something what I have deployed first. What I will do is the next leg I will add is I will go ahead and buy. Okay, a put option which is out of the money. Okay, so I am buying a out of the money put option in this strategy. So now this is a bull put spread. So market going positive. Okay, market being bullish from here, the strategy will give me a profit, right? And if market goes against me, it will give me a loss. But the best part about this is, so see, theta from 400, you cut down this theta to what? Almost negligible. It is just 30. And hence, you can still do some adjustment. Let's say if you go ahead and select 18,400 ka put option, you can do some tweaking around with your legs, and you might also get the strategies which are theta positive in this. So see, just a small change in strike selection, the theta became positive. That means every additional day I hold this strategy, I will be benefited from time as well. So the second strategy we learned is a bull put spread. This strategy is a credit strategy because you're selling an option, okay, but you're buying as well. So you're not facing an undefined loss in this strategy. Okay, that is fine. And this is a credit strategy. So the premium is getting inflowed for you, and this is a theta positive strategy. That means holding this strategy would be lucrative. You will get some theta benefit. Okay, not very significant, but a minute theta benefit. So now coming to the bearish strategy, so completely opposite of it. What we will do is simple. If I have a bearish forecast, I can directly now go to predefined strategies, because this will be completely opposite of a bullish forecast. Now, not a lot of things change. So let's say I am bearish on Nifty. So in Architect, you can select from the predefined strategies. So let's say a bear put spread. Bear put spread is simple. It is opposite of a bull call spread. Over here, what you are doing, you are creating a bearish strategy using put options. So what you have did, you have bought at the money put option. So a higher power put option is something what you will buy, and lower power put option is something what you will sell. Then you can do some changes in the strike selection. Let's say you are selling a 18,400 put option. Okay, so this is how it will look like. Again, the same thing repeats. So this is again a theta negative strategy. So not a lot of things change over here. So this is a bear put spread. Okay, the trade is very simple. You need to buy a higher par put option, which is at the money or in the money put option, and sell out of the money put option. So this is again a debit strategy, and this is again a theta negative strategy. Coming to another strategy, which is a bear call spread. Now it is completely opposite of a bull put spread. In this strategy, what you will do is simple thing. You will create a bearish strategy, but using call options. Okay, so let's say Nifty, and my forecast is bearish, selecting a bear call spread. Okay, so what I'm doing is I am going ahead and selling in the money call option. If you see, let's say I am selling 18,500 strike price call option, and I'm buying slightly out of the money call option. Let's say 18,700. Okay, or let's make it 18,800. Okay, this is the strategy which I am creating. So this is called as a bear call spread. Again, the same things. It is in float. The credit is your net credit on the strategy, and this is a theta positive strategy. So the more you hold this strategy, the more theta benefit you're going to get out of it. Now coming to another market condition, which is either ways, you can call it volatile. Okay, it is also known as volatile market condition, wherein you don't know where the market is going to go, right? So let's say there is a budget getting announced, or let's say a stock is going to announce its result. You don't know where the stock is going to move, but you know that there would be some movement. Either it can be on the upside or either it can be on the downside, but you know that movement is going to happen. A breakout is going to happen either on the upside or on the downside. So in such type of instance, what you can do, can you create a future strategy in such type of market conditions? Absolutely not. You can't go ahead and buy and sell futures at the same time. What you will do is simply you will go ahead and buy a call option, and another leg you will add is you will buy a put option. So long call will give you a bullish payoff, and the long put will give you bearish payoff. So now it will, so the V is getting formed. It is indicating wherever market goes, you will still end up making profit. The only problem in this strategy is that, this strategy is net theta negative strategy. That means if the more you hold this strategy, it will become completely worthless. So my suggestion over here is very simple, that if you are deploying such type of strategies, get out of the strategies. Doesn't matter what happens in the market, just get out of these strategies, volatile strategies, in maybe 2 or 3 days. Don't hold these strategies beyond that. In weekly option, try to get this out maximum by 2 days in this type of strategies, or if it is one day, then it is very good. So it is a long strategy. Okay, the trade is, you don't know where a big move might come. Okay, but you know that there is a big move which might come, you just don't know the direction. Then comes oscillate. Okay, so oscillating strategies are very simple. You might be doing it already as well, and not a lot to explain about these strategies. So the first strategy is a short straddle. Now let's say I'm expecting markets to remain in a range, and I know first thing that the time is going to decay. So what I'll do is I'll sell a call option. But the problem with this strategy is that this is a bearish payoff which is getting created. The theta is, it is giving me a profit, right? 900 rupees theta is something what I'm earning. But the problem is it is a kind of bearish thing. What I will do is I will offset it by selling a put option. Now you see, this is a net theta positive strategy, credit strategy. The margin required in this type of strategies would be humongous. So you will require a big margin to deploy this type of strategy, but this is called as a short straddle. Okay, so short straddle, the problem with, or the benefit of this is that your theta positive, okay, that too with, you know, significant, quantums, you will earn a big chunk from theta. But the problem is unlimited loss, okay. Market going anywhere, you will end up making a big loss in this strategy. Now you don't know, right, that market, if it till expiry it can go to 19,200 as well, who knows, right? But if it goes, it will take, a lot of profit of yours which you have consistently earned. So see, maximum profit is what, 7,500, but it is an undefined loss. So to protect that, what you can do is you can simply hedge this strategy. Okay, you can hedge this strategy by buying wings. So let's say I'm buying 18,800 strike price call option, or you can shift it even higher. You can change the hedges depending on the payoff that you are achieving. So let's say 18,800. You can try to shift it. Okay, no, there is never a static threshold. Always try to shift it. Okay, and let's say 18,300. Okay, or 18,400 put option. Okay, so this is called as short iron butterfly. Again in this strategy, now the best part is, see, you just what, 7,000 profit, say the profit has came down to what, 5,400, but you're not losing, undefined loss. The losses, they are capped. So this is called as a short iron butterfly. So this is a kind of adjustment. Okay, so what you can do is you can modify your short straddle and prevent or restrict the unlimited losses by converting this into a iron fly. Okay, so the trade in iron fly is ATM short, then you adjust it by adding few more legs by buying OTM, call and put. Okay, now similar thing can be achieved using a short strangle. So short strangle is nothing but the moment you sell different strike prices, it is called as short strangle. So nothing a lot will change, but the only thing is a strangle will give you less premium. Okay, it will give you less profit, but it will manage to protect you a bit more. So let's say you are selling 18,700 call option. Okay, and add leg, let's say you are selling a 18,500 put option. Okay, so not a lot will change, it will still give you an undefined loss. Okay, but the only thing is, in strangle, if you see, it is a bit flat and it is a bit widened. That's the only difference. And the strike you have sold, but plus the premium you have received, the break evens get shifted a bit far away. Nothing a lot changes. Again, to adjust this, what you can do is you can buy some hedges. So let's say you will buy a 18,900 strike ka call option. Okay, and another thing what you can do is, let's say you will buy a 18,300 ka put option. So you can hedge this as well, you can modify this as well. So this is called as a long iron butterfly. You can also call it as a iron condor. Okay, this can be also called as iron condor. But hedges, if you are getting enough premium, I would say that it is better to go ahead and do it with a iron fly straight away. You don't need to go ahead and do it strangle, because the premium you are receiving is already very less. So this is the same thing. Okay, not a lot differentiating factor between the iron fly and the iron condor. Okay, so we have learned what, 4 plus 5, 9 strategies. One interesting strategy which I will show you is, which is race against time. In this type of strategy, when you are directional, okay, when you are directional, and you will not get enough theta even if you deploy a credit spread. Let's say you are bullish on the market, and even if you deploy a bull put spread, still the theta was not very lucrative. First, second thing, you still can't go ahead and sell a straddle. The reason being that it is a non-directional strategy, right? It is an oscillating strategy. So what you can do is, you can go to custom strategy and create a strategy which is named as a ratio call spread. In that strategy, what you will do is, you will buy a kind of in the money or at the money strike price call option, and wherever you feel, wherever the target is, let's say I am expecting that market might go to 18,700, I will sell that strike price, but twice the quantity of the bought leg. Okay, so let's say I have bought 50 quantities, I will sell 100 quantities. If I have bought 100, I will sell 200. Okay, so it should be 1:2. So I am going ahead and selling it. So this is a ratio which is getting created. So the best part about this strategy again is that the theta is positive. On the downside, I'm not losing a big chunk. See, even if my forecast goes horribly wrong, I am still what, losing nothing. But if my forecast happens to be right, I will earn what, 3,830. And even if market remains exactly where it is, right now, still I am in the break even, right? I am in still the profit zone in this strategy. So this is called as a ratio call spread. So these are the strategies, which you should deploy, and this will, help you in trading markets in much more better and in an efficient way. So you can take this screenshot and, maybe you can stick it to your wall or whatever. But yes, folks, that was it from my side. And thank you so much for joining me up till here. See you all in the next webinar. And thank you so much. Bye bye. Take care and happy trading.